Thank you very much for your time. I'm going to just run through the presentation that I have here reasonably quickly so I can leave some time open for questions. Just as by way of introduction, as Sarah mentioned, I'm Suresh Wathana. I'm the managing partner of Harmony Capital Investors. Harmony Capital is an investment management firm. We are the external fund manager for Jade Road Investments. Jade Road Investments is an investment company, so it basically holds investments and has an independent board that governs the vehicle itself. It's quoted on AIM. My experience is there for people to see. I don't like to talk about being an investment banker many years ago, but I joined the investment management fray now going on almost 17 years ago. So have been doing this for a while, I have been focused on Asia, and Harmony Capital as a business is based predominantly in Asia, although we also have an office in London and a presence in the Middle East in Dubai. As far as who we are and an introduction to Jade Road, very quickly for those of you that may not know it, it used to be called Adamus Finance Asia. It was rebranded at the beginning of this year as Jade Road Investments. The reason for the rebranding was very simple. The vehicle has changed in its investment focus, its investment policy. Its board has been reconstituted. Its mission is very different from what it was originally set up for about 10 years ago. And so we felt that rebranding the vehicle was a clean way to establish its new identity. And who we are is we're a London-listed investment company that provides long-term risk-adjusted returns from investing across Asia. The focus of our strategy is the SME space, the small and medium enterprise space. Some of you may be familiar that Asia is the largest environment for SMEs in the world. In other words, there's the largest number of SMEs in Asia, and our focus is entirely that SME space and only across Asia. Risk management is very important to us, as it is for most investors. So we are very focused on due diligence. We like to get to know our investors, our investment targets very well. Oftentimes over the course of maybe a year or two, there are some companies we are still talking to 2 years after we first met them to, I guess, get really comfortable with them before we consider investing in them potentially. We have a track record of generating returns, and certainly Harmony Capital as an investment manager has been now operating for almost 16 years. We've managed, and as most people can probably see from the color of my hair, I've been through quite a few investment cycles as an investment manager, going all the way back to the Asian financial crisis, which probably dates me a lot. And then obviously the post 9/11 global recession, the European crisis, the global financial crisis, and obviously most recently the COVID-19 related pandemic related crisis as well. So we've managed money through a number of cycles, and I personally have done the same as well. I mentioned earlier that Jade Road's board is independent. In other words, it is a board full of independent directors. I'm not on the board, for example, even though I'm the investment manager, and that is really about strengthening the governance of the investment vehicle itself and making it truly independent of the recommendations that we as an investment manager may make. Harmony Capital being around for now almost 16 years, originally established by myself in Singapore, obviously has a brand that's established in Asia. We're focused on the SME space and known for that. So that really helps us generate a lot of our investment opportunities, because people know where to come when they're when they're looking to raise money, particularly for an SME venture. We have a large shareholder on our register. It's a investment vehicle that's backed by a sovereign wealth fund. The fund has never revealed its identity. However, they have been on the register for many years. As some people who have followed us for many years would know, however, that investor has continued to be diluted. Originally, when this vehicle was set up, they were a very substantial shareholder, very well north of 60%. Today, they're at 48%, and they have continued to be a passive large investor. And so, as I said, they have been diluted over time in their holdings. I think the most important thing I'd like to focus on is what is the market opportunity. There's been a lot of talk of Asia in the last year. Not all of it's been positive. A lot of it has been sensationalized. However, if you really think about this in the context of Asia as an investment destination, and you look at Jade Road, which is the only listed investment company on the London Stock Exchange that focuses on this Pan-Asian SME space, it's very important to put things in context. This is not my data. This is data coming from ultimately the IFC. There's a $3 trillion US funding gap that's been identified for SMEs. In other words, the difference between demand for capital and supply of capital. And the real reason for that is structural. For those of you who may not be familiar with it, it's going all the way back to the Asian financial crisis, which decimated the banking system in Asia. And a number of regulatory measures were put in by governments at the time to ensure that banks would not lend, not just specifically to SMEs, but would lend very responsibly. So Asian banks are some of the most conservative banks in the world. They don't like lending to SMEs. They'd much rather finance large blue chip corporates, state-owned enterprises, etc. And so that leaves these SMEs in the lurch, really, in terms of where they go to find money and financing when they want to grow. A lot of these companies are able to provide collateral and downside protection for investors like ourselves. As I said earlier, there are 270 million SMEs in Asia. That's the largest cohort of SMEs in any region in the world. And they represent 98% of companies in Asia, actually. They also account for 42% of GDP generation in Asia. So they're really the growth engine of the Asian region. And yet, as the last bullet point says, they only receive about 18 to 19% of lending via traditional institutions. So there's a very significant problem. It's a multi-generational structural gap that has appeared in Asia and will be around for many, many years. If I could just move on quickly to Harmony Capital, the investment manager. We were appointed as the investment manager for Jade Road Investments in May of 2017. And as these graphs show, basically the performance of Jade Road has been relatively stable. Our net asset value has been relatively stable. Our net asset value per share has declined because we have issued some shares and raised some money, as well as issued some shares for some transactions that have all been disclosed in the public domain. But I think I hope the most striking graph is on the right, actually, which is the increase in income that the portfolio has generated. Prior to our appointment, the portfolio is very much focused on China and private equity investments in China, which are traditionally not income-generating investments. You basically invest and hope that you get an exit, and then you make your money that way, which is typically the private equity model. But we have repositioned the portfolio since our appointment under the direction of the board to essentially start investing in and restructuring existing investments and making new investments only with a view to structuring them such that we can generate income for the portfolio. And the reason for that is because the board has publicly stated that it is the intention of Jade Road Investments to become a dividend-paying vehicle. Now, I can't give you any timing on when that may happen, because that's ultimately the board's call, not mine. But just given where our results have been trending, the income generation has started to manifest itself, as can be seen in the numbers. And so I and our team are very positive about that. Now, we have a number of competitive and geographical advantages. I'm not going to bore you with going through every single one of them. I guess the most important one is that we're Asian focused. We're an Asian investment company. We're an Asian investment manager. Most of my team and myself have Asian experience, are Asian, are based in Asia, even though I'm currently based in London, and we have an office here in London with a number of people based in our team here. Most of our investment team is actually based in Asia, in our offices in Hong Kong and Singapore. We're a great believer, and I'm a great believer of engaging in what can be called hand-to-hand combat with our investees. In other words, we like to see the whites of their eyes. We like to visit them. We like them to know that we're around. And I think that's a significant advantage as opposed to picking stocks across a computer screen and across oceans and across time zones. We're actually based in Asia, and I think that's really the most important part of our competitive advantage. We're very focused on risk management. As I said, we will not invest unless we have fully diligenced an underlying company, and that's essential part of our investment process. So we really are very focused on that, and our idea is to continue to diversify our portfolio. Jade Road is a pan-Asian vehicle. Currently, we have about half of our exposure in China. We will always have exposure in China because you can't be credibly pan-Asian and ignore China, the world's second largest economy, and one day what will be the world's largest economy, and certainly the largest economy in Asia. but we want to continue to diversify, as we have over the last 3 years, our exposure across Asia. And so you can see there that we have already exposures across other parts of Asia, including Japan, Singapore, parts of Southeast Asia, Hong Kong, etc. We're a sector agnostic. Sounds like a great fancy term. However, what that means is that we're very opportunistic. Whatever makes us money, and more importantly, what makes our shareholders money, is what we will take seriously. So that means, by definition, we don't look specifically at any one sector. There are a number of sectors that are very attractive in Asia, of course, starting with consumer and leisure, obviously internet and technology. So with the move to particularly online retailers, online consumption, particularly as a result of what happened over the last year and in 2020. All of these are thematics that we're starting to see a number of opportunities present themselves in the SME space. Healthcare and life sciences has always been an area that we've been seeing a lot of opportunities in. Asia is an aspirational society and continues to be. And as an aspirational society, things like education and healthcare are front of mind for a number of people across the region. And so this leads itself ultimately and thematically to those sectors being particularly attractive to invest in if you can find the right companies. And we believe the SME space is where the richest opportunities exist. Our investment process, as I said, is highly disciplined. I think the most important thing to take away from this graphic, and this is all available on our website, but is that, in between 2019 and 2020, also accounting for the fact that obviously we had COVID to contend with in 2020, but we made approximately 2 investments of over 100 companies that we fully analyzed, and in some cases actually diligenced physically. So we're very, very selective. We make no apologies for that. We're handling our own money, but most importantly, our shareholders' money as well. So it is our responsibility, fiduciary duty actually, to be extremely selective about what we invest in. And so therefore, our how we invest is very, again, very fluid. We can invest across capital structure. So again, we're not like a private equity fund where we only buy an investment or invest in the equity of a company and hope that it all works out while we're the minority shareholder. Quite the opposite. We're an active investor. We like to structure our investments either in the form of a convertible bond, a secured loan, maybe preferred equity with governance rights, or loans and warrants, etc. There are a whole host of reasons why SMEs want to borrow or want to finance, raise financing. That can be all the way from organic growth to inorganic growth to, they have liquidity needs, they have refinancing needs, etc. But when we engage with an investment company, we're always thinking about how to structure the investment to ideally have some downside protection, but also give us income, but also potentially give us upside. So, we like to have our cake and eat it too. And the wonderful thing about investing in that SME space is that you're principal to principal. So we are negotiating directly with our counterparty who may be an investee. So if we can't agree terms, if they're unreasonable, they're not disclosing the information we want in due diligence, or any other host of red flags that appear, we walk away because we're not compelled to invest. And that's the discipline that I think I'm most proud of our team exercising on a daily basis, which is we don't have to do a deal. We're not deal junkies. We're there to find the best opportunities for our shareholders. And we've shown that to be the case, at least for the last few years. I think our portfolio has, as I said, morphed and changed over the last 4 years. As I mentioned earlier, when we inherited this vehicle, it was 100% focused on China and Chinese private equity investments. We spent a lot of time, probably 3/4 of the first 3.5 years, focusing on exiting and restructuring those investments. They were not for the faint of heart. And given our expertise, given a lot of my team is actually from mainland China, even though we operate out of Hong Kong, and almost all of them, without exception, are all Western educated and Western trained. We have a very effective team on the ground who speak the language, understand the nuances, but think in a very international way, which is important to me and to the team at Harmony Capital. So our portfolio has undergone a transformation. It is continuing to transform. Our largest asset is a quarrying business in China. So this is a very simplistic. The way I describe it is we blow things up and we crush it and we sell it. And that's pretty much as complex as it gets. We manufacture magnesium dolomite for the magnesium smelting industry, as well as products for the construction industry. We also own a 70-year-old business in Hong Kong in the food and beverage industry. As you can imagine, 2020 was a difficult year for food and beverage all over the world, not just in Hong Kong. However, this is a 70-year-old business that has withstood the buffering of the Asian financial crisis, SARS, for those that can remember that far back, and all of other issues that have roiled Hong Kong in the last 10, 15 years, and they have managed to survive that. So it's a very resilient business, a very well-known business, 70-year-old, as I said, and we own a convertible bond there. Maze Energy is a very interesting investment that we have in our portfolio. It is one of the largest manufacturer of wind turbines, blades in China. For those of you that don't know, China has already announced that it has an intention to be net carbon neutral by 2060, I believe it is. But more importantly, China is one of the world's largest producers of offshore wind energy today. And our business is a major supplier of wind turbine blades to both the offshore and onshore wind turbine industry. And so it's a very exciting business that we own a stake in. We also own a stake in a business which is a digital healthcare platform called DocDoc that is one of a kind. It's a 8-year-old business, so it's not a startup, 7-year-old business, my apologies, and operates all across Southeast Asia. We also have an investment in a business that has developed luxury villas in places like Japan, in the ski fields of Japan, actually, in Niseko and the island of Hokkaido. So the portfolio, just to give you a very quick sense, is reasonably diverse. And as I said, we will continue to diversify that portfolio as the opportunity presents itself. We've raised money only once in our tenure as Harmony Capital since May 2017, and that was last year. And we will continue to look for opportunities to deploy capital into new investments as they present themselves. But I would, again, go back to what I said earlier. We're a very disciplined investor. And so we think there's immense opportunities coming out of the sort of post-COVID-19 recovery. But it's also a time to be very disciplined and have a very level head as we look at the opportunities that do inevitably come across our desks. I think that's about it. I think the last thing was just to introduce the board. Sarah already mentioned John Croft. John is chairman, he's executive chairman, has been for several years. All of the board own shares in the company. The investment manager, including myself as managing partner, but the investment manager, Harmony Capital, is also a substantial shareholder of this vehicle. So we are all aligned with our shareholders. The board comprises of people with experience ranging from investment banking to operational expertise across from Asia to Europe as well as the Middle East. So we have a very diversified board. It's not a board that just rubber stamps investments. It takes its job very seriously. And we have a lot of interesting discussions with our board whenever we present an investment opportunity, because they act as the investment committee while we are the investment manager. So that's really Jade Road in a nutshell. Our current share price reflects a very significant discount to our latest net asset value. And we think it's an interesting opportunity, as obviously our chairman also thought so by buying shares earlier this year, as Sarah mentioned. And there's plenty of information available on our website if people are interested. And I'm happy to take any questions, Sarah, or take your questions for that matter.
Thank you very much indeed. Yes, I was worried that you weren't going to get to the board, because it is one of the most well-connected boards on the London Stock Exchange. When, you know, I think we should keep this particular slide up so that people can read the biographies of who is involved with the board. I like the way that you said the SME space is where the richest opportunities lie, but at the same time you introduced a caveat, which is you are not a deal junkie. You're very selective. You have analyzed hundreds of companies. So therefore, what is the criteria for an investment opportunity? What does the opportunity have to present?
I think for us, you know, one of the main things which is very difficult to quantify, Sarah, is, you know, a willingness from the company we're doing business with to be open and transparent and be willing to agree to the kind of demands that we would place on it were we to become an investor. As I said, we're a very demanding investor, actually, when we do invest. So even if we invest in the form of a convertible bond or a loan, we have covenants, we have requirements, we have board seats that we ask for regular reporting, we ask for We will be asking for things like ESG reporting going forward, etc. So the moment, everyone wants to be your friend when you have the checkbook out, but no one really wants to talk to you after you give them your money. At least that's been my experience over several years, which probably again explains my appearance. So we're very cautious about the type of company. So initially, it's a kind of getting to know somebody. When I say somebody, I mean a board, a management team, how willing they are to engage, how willing they are to be transparent, how open-minded are they to have a professional institutional investor become part of their business. And then, of course, it's about, dotting I's and crossing T's, which is getting really into the detail of due diligence to look for any spiders in the closet, so to speak. But we don't have any specific criteria. As I said, we're very opportunistic. One day we could be looking at something in the healthcare space. The next day we could be retail. The next day it could be property. We'll look anywhere for opportunities as long as they make sense on a risk-reward basis. And we believe that hopefully that investment will make money for our shareholders.
Well, Suresh, you look just fine. White, grey, silver, it's all the rage at the moment, but I'm quite sure that there are some elements of the business which might be contributing to a certain hair colour. Tim Grattan asks, what is the current discount to NAV? How has this discount changed since you took over the management of the fund?
Well, actually, when we first took over the management, I mean, the numbers are available publicly. I think the discount was greater than 75% or something like that. It was something absolutely ridiculous. The discount isn't much better today. I think it's in the mid 60s, or it fluctuates between 60-65%. So it's still a very significant discount. I think, in a sense, one of our biggest priorities and one of the board's biggest priorities is to continue to ensure the market remains fully informed of the opportunities that this current portfolio presents, but also the pipeline of opportunities that we see ahead of us. So that, eventually people understand that trading at a 60% discount either says that, the business is on its last legs, which clearly isn't. It's a self-sufficient business that generates income, or there's been a disconnect, and that's where the opportunity potentially lies for investors before that discount narrows.
Okay, so apart from a very vigorous communications strategy, another question from Tim: what measures are you taking, if any, to manage that discount to NAV?
Well, in the past, we have announced and we have acted upon, because there have been filings of the company stepping in and buying back its own shares. So there has been a buyback program that's been active, and it's still active. So we've tried to provide the support that a company should provide to the market, at least as a signaling of confidence that once price drops below a certain point, that we will be willing to step in, and that's been done. The other things that we have also done is looking to actually diversify our shareholder base and to reduce the overhang that's been perceived, even though it's not actually an overhang, of our major shareholder. As I said, they were originally around 75%, I think, when we first took over. Now they're at 48. They're below 50. They have one representative on the board, but that's it. So we've continued to try and whittle away at this in many different ways. We've also tried to. We have raised money last year by again broadening the investor base, and we've also started, an outreach program to the retail market as well. And events like this hopefully help that. What we're trying to do is get the story out to many people and as many different constituents as possible.
Well, Michael Robertson has been doing his homework. He says to you, can you comment more specifically on your main legacy China investment, FMH, the now operational mine? When will it be cash flow positive, and what will your trigger be for divestment of this asset?
It's probably facetious, but my trigger for divestment is a very large check. Anyone wanting to buy it from our audience today, I'm open to discussions. Look, being more serious, the reality is we've made no secrets about the fact that this is not an asset we want to own. It's an asset we own because of the legacy that we inherited. We spent a lot of time rehabilitating the asset, again, which has all been publicly disclosed, and getting it operational, which was no mean feat. It took 3 years to do that, to get it licensed, et cetera, et cetera. When will it be cash flow positive? We actually provided some guidance in late 2019 that shows that the company would be cash flow positive, at current operating capacity. So we gave some guidance on that for the very first time. In 2020, what we did was consolidate the asset. In other words, we just focused on keeping it stable, making sure that the company survived what was effectively a shutdown of the Chinese economy for 6 months. And we're hoping to provide an operational update with our annual results, which should be coming out at the end of April, if not early May this year. So we will provide more color to the market. My hope is that eventually the board sees fit to provide financial guidance on this specific asset, which it has never done before, because frankly, we've never been in a position to do so. So investors, like the gentleman who asked the question, can just get a better handle on what this asset actually means. So we do hope to provide a lot more transparency going forward.
I think it's worth reminding investors about some figures that we got in January, which is that China reported 2.3% GDP growth for 2020, and it's likely to be the only G20 economy to post GDP growth for last year. So actually, you are in a sweet spot.
I think that's something that, people, the astute investor, hopefully can see, which is see past the noise. I said it earlier as an offhanded comment. There's been a lot of sensationalism, obviously, that sells rather than facts. The reality of Asia has been very badly affected by COVID-19, but the recovery has also been a lot more brisk than people realize. China is just a headline, which is that their economy has done relatively well compared to other countries. But all of Asia is opening up as we speak, and we are very excited about the prospects that come. So I think any astute investor should sort of, as I said, look through the noise and focus on the actual numbers out there. Asia is a terrific investment opportunity, and we believe our vehicle obviously is a great conduit for that.
And the astute will know that jade is a symbol of balance and strength. It's also known to protect and bring harmony. So in terms of Harmony, which is the company that you co-found, and Harmony is the investment manager for
Yes.
Jade Road Investments. Robert Jenkins asks, does Harmony only manage Jade Road, and how is Harmony paid? Yes,
we only manage Jade Road. I live, breathe, and eat Jade Road. As we've discussed before, Sarah, there is no other thing that matters from a business perspective to me than Jade Road. And the same applies to my entire team across the Harmony network in London, Singapore, and Hong Kong. As far as how we're paid, it's a very traditional vanilla model. We get paid a management fee and a performance fee if the performance of the business merits it above a hurdle. That's all in the public domain. It's actually even on our website, but just for the benefit of everyone listening, we get paid 1.75% a management fee based on audited NAV. And we also get paid a performance fee of 20%, half of which, if it is payable, which in the past, in some years, we haven't been paid any performance fees, but if it's payable, half of it has to be paid in Jade shares. So we can't take it in cash, all in cash. So that, again, further aligns us with the business.
So finally, can we go back to the slide which shows the portfolio, the
Yes.
entities within the portfolio? There you go. Out of those investments, which one would you like to own more of?
That's an excellent question. I think, it depends on which one's going to make us the most money on exit, right? I still think as an investment manager, it's all about making money for my shareholders. I would say that the companies with the most potential for upside, if I can answer your question, perhaps in a slightly circuitous way, are companies like DocDoc, because this is a very exciting business that operates across the healthcare space in Asia. It's basically a company that I've been on the board of, so I know it intimately well. It's a patient empowerment company, which basically means that, when you need something for some kind of medical emergency or medical care, you have a database which provides you with a sanitized version of what is the best care for you and lets you pick it. As you know, medical care is one of the most opaque industries in the world. You basically go by what your mate tells you, is the best doctor to go see, but there's no real science behind why you should see Dr. A versus Dr. B, whereas DocDoc provides that in Asia and across Southeast Asia. So I think that's a company with significant amounts of upside, potentially an IPO candidate, could be a takeover candidate. So if I could own more of it, that would be one that I would put on the top of the list.
And if I was a betting woman, and I wish I was, I knew you were going to say Dr. It's a very good company indeed.
Yeah, there you go.
I can fully understand why you'd want to own more, although it doesn't necessarily have favoured status within your portfolio, because you apply the same amount of attention to detail to all of your investments, current and prospective.
Yeah, I often warn companies, and when we have discussions with high level, chairmen of the board or the CEO, I often tell them, look, I know you guys want to be friends, but we're not going to be your friends. We're an investor, so we want to be friends, but ultimately our responsibility is to manage the money we've been given responsibly, and that makes us, sometimes a painful investor to have. A disciplined investor can be a very painful investor, and we'd like to think of ourselves as that. So yes, we apply a lot of rigor to the investments that are in the portfolio, but equally to the ones that we're considering putting into the portfolio in the future.
And here's me thinking I was the smiling assassin. Suresh Withana, investment manager of Jade Road Investments. Thank you very much indeed. Again, wished I'd had more time with you. Thank you very much.
Not at all, Sarah. It's very nice to see you. Thank you again.